Well, welcome back. Welcome to another episode of the Rogers Capital Market Commentary, where we attempt to cut through the noise, cut through the headlines we're bombarded with on a daily basis, be your antidote to the prevailing wisdom of the day. So, show of hands, if this sounds familiar to you, 2026 is a year where volatility will be the headline. Does that ring a bell with anybody? Does that sound familiar to you? Go ahead, get them up. Get them up high. Yeah, that was actually the last line in last month's video. Right. Yeah. Before shutdown politics, before Iran, before all of the drama that we've been dealing with the last few weeks. Now, that drama feels a bit more personal. And as we speak, the market's down 5.5% from its recent all time high. Technology stocks down a little more than that. If you've looked at your statements, that number might feel heavy. But before we let apprehension take the wheel, let's look at why this is actually a normal part of a healthy market cycle. Today, we're going to look at the history of these pullbacks, why your retirement plan's built to handle exactly this kind of weather. So, number one, the reality of this pullback. First, we have to normalize the scary feeling of a down market. Here's maybe a little clearer way to look at it as the price of admission. Think of market drops not as a sign that something is broken, but as the price of admission for long-term growth. Even in the best of times, the roaring 20s, the great 80s, even the great bull market of the late 90s, the stock market is rarely at that all-time high, those perfect all-time highs. In fact, history shows that market is in some state of pullback, meaning down from its peak, the vast majority of the time. Here's how those numbers break down in just straight English. First category is that 0 to 5%. We'd call that the dip. Since 1950, the market spent roughly 70% of all trading days in that down 0 to 5, just slightly below that all-time high. Okay. The second category, this is the normal state of the market, that 5 to 10% correction is what we'd call this. About 18% of the time, the market's down between 5 and 10. And this is where we are right now, down 5.5. We've been down as much as 9. The third category is the rare deep drop, which is actually quite rare for the market to stay down more than 15%. This only happens about 6% of the time. So why does this matter for your retirement? When you hear that the market's down 5.5%, it feels like a crisis because it's the headline. But when you look at the data, you see that being down 5 to 10% is a frequent, even an expected part of being an investor. Instead of viewing this 5.5% drop as a reason to panic, history suggests we should view it as a recurring feature of market behavior that often creates an opportunity for patient investors. Second point, lessons from past conflicts. A lot of this current volatility is tied to the headlines out of Iran and the closure of the Strait of Hormuz. But history is a very consistent playbook for military conflicts. Stock market's shown significant resilience during major military conflicts. On average, the S&P 500 experiences a 7% drawdown following these types of events, but recovers those losses within an average of about 55 days. For example, Pearl Harbor, 1941, the worst of these, we were down 20%. And it took a year to rebound. But North Korea invading South Korea in 1950, the Cuban Missile Crisis in 62, the Tet Offensive in Vietnam, 68, Iraq invading Kuwait, and then, of course, the Gulf War, 1990, was actually the second worst drawdown, 17%. 9/11, the terrorist attacks in 01, that was the third worst of these is the 9/11 drop. That was 12% drop. The Iraq War in 2003, Russia-Ukraine in 2022, and other notable events factored into this average. A Hungarian uprising in 1956, the Suez Canal crisis in 56, the Gulf of Tonkin in 64, Six-Day War in 1967, Yom Kippur in 73, Israel Hamas last 2 Octobers ago, I guess now, conflict. What's the historical drawdown? Well, during significant military operations, the S&P 500 typically draws down about an average of 7%. What's the recovery window? The average, 55 days. So historically, the market recovers these specific losses in less than 2 months. Okay, but what about today? April 2026, we reached a 9% peak to trough. March 30th was the low. Hopefully it stays the low, right? But 9% peak to trough from all-time high to March 30th. We're currently at 5.5 down. So, that in itself suggests that maybe we've already seen the worst of the conflict selling. Okay, point number 3, the story, right? If those are the headlines, what's the story, Corey? Well, fundamentals and earnings. If the headline is the conflict, then the story is the earnings power of American companies. Despite higher oil prices, the outlook for 2026 remains strong. Tech companies, tech earnings, consensus estimates for the tech sector actually rose 6% just in the last 30 days. Energy earnings, energy companies, of course, doing well with price of oil where it is, but their earnings estimates have jumped 18% as companies adapt to the current macro environment. The overall growth, we still anticipate double-digit earnings growth for the S&P 500 this year, 2026. Double-digit earnings growth. So let's take a look at our updated dashboard. Across the top, we've got the indicator, what economic indicator we're referencing, the current value, and then the light, be that green, yellow, red, and then the context, some info added, I guess, detail there. Manufacturing, PMI is at 52.7. That's actually up from 52.4, which indicates, first of all, green light, but secondly, sustained industrial growth, which is interesting given rising input costs, energy, et cetera. Yield curve, the 10-year over the 2-year, we're still at plus 50 basis points. So, green light, again, slopes positive, it's remained positive. And historically, that's a sign that immediate recession is low. The risk is low. Inflation, core CPI, year over year, 2.5. That's green. It's barely green, but that is green. And it's trending downward from previous highs, slight little twitch up month over month, but trending downward. The VIX, here's the problem, all this geopolitical stuff going on. We're at 24 on the VIX, and that is elevated. That's not yellow light, that's red light. Significant jump from 15 we had earlier in 2026. Of course, Iran, Straits of Hormuz, the president texting, you know, dramatic things, hysterical things. Doesn't help, all of that. Earnings revisions, we're positive on earnings revisions. They're revising to the upside. Q1 2026, 13%, growth led by tech and energy. And credit spreads, safe bonds versus risky bonds, a 54 basis point spread that remains tight, suggesting that corporate credit markets aren't really pricing in a crisis, challenging, situation yet. So what's the takeaway? Stocks have a very strong track record of gains during years where earnings growth is double digits, and we're sitting on a dashboard like you just saw, 5 greens, 1 red. Okay, this fundamental strength is the resilient backdrop we talked about last month. Okay, and number 4, action plan. Okay, what do we do? We got to fight through the drama. We've got to fight through the headlines, remain disciplined. How do we stay disciplined? Well, we watch the data. We watch earnings. We watch the lights. Wall Streeters are actually kind of currently watching several key technical indicators, levels. One is the 200-day moving average. We dipped below it slightly in March, and right now the market's fighting to get back above that 200-day moving average. Reclaiming that level, I think, would go a long way. It'd be a huge green light to indicate this bull market trend is resuming. Until then, we stay patient. We remind ourselves about earnings. We remind ourselves of these lights on our dashboard. And but really, that just this recent bounce kind of gives us some confidence that buyers are definitely starting to step back in. Wall Streeters starting to ease back in. Why this matters for you? Well, knowing exactly what these confidence points are helps remove the mystery of why the market's choppy. It's not random. This is a battle between buyers and sellers and information and facts and emotion. And it really, historically, this is the way it goes. It's the price of admission for being an investor. And so for your own plan, here's the focus. Be patient. Avoid the urge to make emotional changes based on the 24-hour news cycle. In fact, just turn off the news. Seriously, just put the phone down and go do something else. Watch golf. This is Masters week. Okay, watch the Masters. You'll either enjoy Augusta and golf, or you'll go to sleep, and then that's not too bad either. So, secondly, revisit this dip as an opportunity. Happy to have a conversation, okay? Ensure your allocations haven't drifted too far from your target. So yeah, your plan is impacted by this volatility. And then, we're maintaining, thirdly, we're kind of maintaining a patient but neutral stance on equities and favoring good, solid, strong quality and rebalancing into these opportunities, okay? So in conclusion, the noise, I get it. I hear it. Kind of jumped out at me this morning. The noise is loud right now, but the data's clear. We've been here before. The market's shown us time and time and time and time again that it can digest geopolitical shocks when the underlying economy is strong. Stay focused on your long-term goals. Keep your discipline. Remember, we're managing for the next year, the next 5 years, the next decade, not the next headline. If you're feeling uneasy, you feel like you need to take a second look at your specific plan numbers, well, I mean, we're here to help you filter out the drama. Okay. So we'll see you next time.